I stopped my TBill ladder. What about you? Hello, members, super savers, and bond course fans, and welcome back to our weekly update video. I hope you're healthy and well, and that you've missed us as much as we've missed you. So, I'm curious as always, are you still laddering T-bills? And if you are still laddering your T-bills, which maturities are you laddering? If on the other hand, you're not laddering T-bills anymore, where are you putting your money right now? Drop a comment below and let the community know. So, with that in mind, here are the 3 topics that we'll be covering in today's video. 1. Are we still laddering T-bills? This is a question that I get all the time, and one that my brother-in-law actually asked me over Labor Day weekend. So I figured a T-bill ladder update would be a great way to kick off our first video after the short summer break. 2. Where did Treasury yields end this past week? And 3. What's on the upcoming Treasury auction schedule? And what are the highest yielding new issue agencies, corporates, and brokered CDs currently? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. This right here is the actual conversation that I had with my brother-in-law over Labor Day weekend as we were putting a whole chicken on our grill. He stopped laddering T-bills and wanted to know what we were doing. As our Diamond NestEgg regulars know, I started laddering and auto-rolling 13-week T-bills nearly 2 years ago in one of my retirement accounts in nice round intervals of $20,000. And this is what the T-bill ladder in my retirement account still looks like today. More or less at any given point in time. Very pretty and organized, spaced out in even intervals with even amounts set to mature and auto-roll into the next tranche of 13-week T-bills. I also have a 4-week T-bill ladder running in one of my brokerage accounts, which looks a bit less pretty and structured. It's what some of you in our community refer to as an uneven stepping stool. Here's an illustration of what this 4-week T-bill ladder in my brokerage account might look like. As you can see, while they are all 4-week T-bills, the amounts are not always the same, and there is a step missing from the ladder. Occasionally, I'll have a ladder that's missing even more than one step. And the reason for this is that this T-bill ladder in my brokerage account is where I park any excess cash as well as where I pay any major outgoing expenses from. So the amounts that we have in those ladders tend to fluctuate more than they do in my retirement account. So, yes, to my brother-in-law and to all of you who've asked, we are still laddering T-bills, and the reasons for doing this are the same as they were when we first started. 1, we have been and continue to get 5% plus yields on our 4-week and 13-week T-bills. And yes, those yields will come down when the Fed starts lowering rates, but so will yields on any high-yield savings accounts and money market funds that we would consider reasonable alternatives. More on this in a moment. 2, interest earned on T-bills is exempt from state and local income taxes, which makes quite a difference if you live in a high income tax state and hold T-bills in taxable brokerage accounts, like we do with some of ours. And 3, T-bills are still the safest, most liquid, fixed income investment in the world. Now, let's go back briefly to this point here. As I mentioned earlier, these 5% plus T-bill yields will come down. And those of you who've purchased at recent T-bill auctions know that firsthand. The market has already priced in that the Fed is widely expected to start rate cuts at this month's FOMC meeting, as Fed Governor Christopher Waller basically confirmed this past Friday in his speech titled, "The Time Has Come." The time to cut rates, that is. And this should come as no surprise, really, given the recent softer than expected inflation, jobs, and other data. The 2 interesting takeaways we had from Governor Waller's speech were: 1, the Fed doesn't seem to believe that we're necessarily headed towards a recession in the near future, which, as our Diamond NestEgg regulars know, we don't think so either. Despite the moderation in the labor market over the past few months, consumer spending and our economy are still experiencing solid growth, at least for now. And 2, while it looks almost certain that the Fed will cut rates at this month's FOMC meeting, the pace and timing of future rate cuts remains to be determined. Fed Governor Waller basically said that the Fed will make its rate cut decisions meeting by meeting, based on the latest inflation, jobs, and other economic data, just as it did when they raised rates in recent years. Meaning that the somewhat unpredictable bond yield roller coaster we've all been on may continue for a while. For now, though, as of the time of this taping, T-bill yields are still above 5% at the short end. And for now, we are still sticking with our T-bill ladders. If and or when short-term T-bill yields drop significantly below 5%, then we will need to reevaluate the situation because given our age and stage of life, I have no plans to buy longer dated bonds at the current rates. And because I know some of you will ask, my brother-in-law, the one who asks me this question, he moved his T-bill money into a municipal money market fund at one of the leading brokerage firms. He's a busy young guy in a high tax bracket looking to potentially buy a place with that money. So it makes sense for him. As I always say though, everyone's financial journey is different. And as I also always say, if I was planning to retire soon, or if I was already in retirement, I would likely not be parking so much of my cash that's earmarked for longer term use into short-term T-bill ladders, money market funds, or savings accounts. Rather, I might be going out longer with my fixed income investments to capture rates while they are still attractive, and also so that I can sleep well at night, because markets are unpredictable. And locking in now a rate that I can live with may give me more certainty for retirement. And if this is you, if you are planning to retire soon, or if you are already in retirement, stay tuned for our upcoming videos and especially the next one, because that is what we'll be talking about soon in a new video that will address a very pertinent question from one of our members. Or come join our bond courses to get up to speed as quickly as possible on bond investing and how to build your bond portfolio. Use coupon code FALL2024 to get a 10% discount on all our courses before midnight Eastern Time, 9 p.m. Pacific Time on Sunday, September 15th. And as a reminder, our next live Bond Masters course session is happening this weekend on Sunday evening at 5 p.m. Eastern Time, 2 p.m. Pacific Time. And our next live Bond Beginners course session will be in October. So, with that in mind, let's move on now to the next section of today's video. As we so often do at the end of a week, let's see where we stand and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. As you can see, Treasury yields were down for the week across every maturity, which again is to be expected given what we talked about just before regarding softer than expected economic data and Fed Governor Waller's speech about imminent rate cuts. Now, let's take a look at Treasury yields from this past Friday versus the beginning of this year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd. And this row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Decreases in rates are shown in red. Treasury yields across all these maturities are now lower than where they were at the start of the year, with the smallest differences to be seen on the long end here. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what is shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of this video, especially for those of you who are interested in agencies, corporates, and brokered CDs as well. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. And if we scroll down further, we can see the 3-year T-note, the 10-year T-note, and the 30-year T-bond will be auctioned off as well this upcoming week. The 3-year T-note is not a reopening auction, so the coupon still remains to be determined on auction day. The 10-year T-note and the 30-year T-bond are reopening auctions, so we already know what the coupon will be on those. At the time of this taping, here's what the coupon and the expected yield are for the 3-year T-note auction on Fidelity's platform. And here's what the coupon and the expected yield are for the 10-year T-note auction. And here's what the coupon and the expected yield are for the 30-year T-bond auction. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. For those of you interested in agency and corporate bonds for a bit of a higher yield, here's where the highest yielding new issue agency bonds stand at the time of this taping. For corporate bonds, here's where the highest yielding new issues stand at the moment. And for brokered CDs, here's where the highest yielding new issues are currently. Remember that regardless of whether we're talking about agency bonds, corporate bonds, or brokered CDs, currently the higher yielding ones that are a bit further out in terms of maturity are generally callable. So keep an eye out on when the first call date might be on those. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And if you want to learn about the safest, easiest, and fastest ways to get started with bond investing and building out your bond portfolio, especially in times that may see continuing market uncertainty, then check out this video here on our 2024 bond courses. Use coupon code FALL2024 to get a 10% discount on all our courses before midnight Eastern Time, 9 p.m. Pacific Time on Sunday, September 15th. And as I mentioned earlier, our next live Bond Masters course session is happening this weekend on Sunday evening at 5 p.m. Eastern Time, 2 p.m. Pacific Time. And our next live Bond Beginners course session will be in October. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and CDs this coming week, and see you again very soon with more brand new wealth building content for your financial journey.